Hi, good afternoon, everyone, and very warm welcome to Logical Talk 21. Our This is our 21st webinar in the series, and we are very thankful to all of you to keep supporting us and keep pushing us to continuously doing this. This is 21st month, and we are back with one of the very engaging topic which we had done a webinar earlier on when the previous amendments came in the SEBI LODR, and we are happy to bring Vivek back to continue that discussion also. And I'm sure you have linked to that webinar also. Many of you would have already seen that, and we'll continue with that. But before we jump on to our discussion points for today, I would do my customary discussion. I'm sure this slide is looking slightly different for you because we tried, because that was getting very boring. So we thought at least we'll try and make some changes. While I want to say the same thing which I've always been saying. We are a leading regulatory technology company providing global regulatory technology solutions. The software which we have called as GCMS, which help businesses manage their regulatory risks across the country, across the globe. So if you are wherever you are, we would be able to provide you the services. Today we have served more than 70 countries. And the software comes integrated with the regulatory intelligence, and our team of lawyers, which are 80 plus legal and tech professionals we have, they keep updated on a real-time basis. As and when the changes are coming in the laws, they keep it updated. And beyond that, we have other softwares like legal matter management, which is litigation management, enterprise risk management software. And today, more than 450 plus enterprise entities, having 2,500 plus locations, are using our services across India and 70 other countries. And we have maintained 100% enterprise client retention so far, which is very enviable in the market. And also thanks to the support which we have received from our clients, our users, and the continuous feedback, which has helped us improve on these softwares and services and keep serving you again with the same zeal. So now coming on to introducing Vivek, I'm sure you've received an invite. You know Vivek already. Vivek is a speaker in many conferences, and I've seen him more active in ICSI. So if you're a company secretary, I'm sure you've heard it. You have interacted with him. So he doesn't need much of introduction, but still I'll do my customary thing. So Vivek is a seasoned legal counsel with more 18 plus years of experience, and he has served across diversified industries from logistics, airport, hospitality, and he's been working with some of the very leading names in the industry and listed entities. Today he is the head of legal and managing the legal and compliance operations for the company across the globe, and he has he has been part of bringing taking the company to the IPO level, manage the existing listed entities, and have worked across investment, commercial contracts, lifecycle matters, CLM litigations, and compliance, corporate governance. And one thing, and I'm sure if you have attended the previous discussion with Vivek, you would understand the kind of depth understanding Vivek has. It's phenomenal in in specifically to the compliance, and the way he goes deeper into it to explain it makes it very, very interesting to understand. And one disclaimer before we jump on. While I'm also not taking the name of the company he represents, because this discussion is purely is a personal initiative. Not It does not, whatever discussion, whatever views we are going to have share here today. These are very personal views basis Vivek's understanding and his experiences. It has no reflection of the company which he's currently associated with. It is nothing in his official capacity. And idea again of these discussions are that we learn from each other's experiences. We learn from the challenge which we are facing, all of us facing, and like we always do, we will keep this discussion interactive. You keep writing onto the chat box if you have any queries or concerns. While you have already shared your concerns and your questions with us, which we will try to address during this conversation, or some of those questions we will try and address towards the end of it. But in between also, please feel free. My colleague Mayank, he will also be pitching in with with your concerns and queries. Vivek, Mayank is the company secretary and comes with 10 plus years experience, and today he is leading the implementation and advisory services for Lawbit, and been with he's somebody who has built the company from the scratch along with me, and today all the data, all the content which you are getting from us, all the implementation services which you're seeing from us is somewhere has been done by Mike and his team. So I hope you enjoy the discussion. So Mike, over to you. Please walk us through what we are going to cover today. Vivek, welcome, and excited to hear you.
Thank you so much, Jyant, for the wonderful introduction. And I'm sure I have seen you and Mayank, you have both have been doing great work. And I'm glad to be back on the 21st session.
Mike, why don't you,
Yeah.
by the time you project the slide, why did you start with?
Good evening, everyone, and thank you, Jyant sir, for the introduction. It gives me immense pleasure to welcome all of you to today's webinar on SEBI LODR, a review of recent amendments that came on December 12th. So this session is thoroughly designed to provide a comprehensive understanding of the latest changes and updates introduced under the SEBI LODR regulations. So these amendments aim to enhance transparency, accountability, governance, which are vital pillars of the corporate ecosystem. So while preparing for this session and reviewing the amendments, one name kept surfacing repeatedly, that is expert committee. Recent regulatory changes stemmed from the recommendation made by this committee, which SEBI formally adopted. So even the subject of SEBI circular dated 31st December 2024 clearly states that clearly states the purpose and the subject line of that circular was implementation of recommendation of the expert committee for facilitating ease of doing business for listed entities. So it is evident that these amendments have been introduced to provide greater ease to listed entities while ensuring robust governance practices. The expert committee for facilitating ease of doing business and harmonization of ICDR and LODR regulations was constituted by SEBI in August 2023. And its mandate was to conduct a comprehensive review of existing regulations of ICDR and LODR. And what was their objective? That whether is there any scope to simplify the processes, reduce compliances, cost, and improve timelines for the listed entities in India. So this initiative also aligns with the union budget, which came in last year, and that budget, emphasis on streamlining the regulatory framework for fostering a business-friendly environment. The committee key focus area including simplifying procedure, easing timeline, leveraging the use of technology for filings, rationalizing legal provisions, and most importantly, enabling effective governance. Some important recommendations from the expert committee, which are reflected in the amendments of these LODR regulations, include single filing system. So, single filing system and integrated filings. So both stock exchanges are building APIs to facilitate the seamless sharing of information and disclosure between exchanges. This means companies will eventually need to file documents with only one exchange, and which will be automatically share the data with the other. The other one is the integrated filings. The objective here to minimize the number of periodic filings required from companies. So we will cover this in detail while discussing Regulation 10(1)(a). System-driven disclosures, again, regulator aims to leverage the technology to fetch information automatically from various authorities, agencies, include and this will reduce manual interventions. Website disclosures, companies now only need to provide web links of stock exchange instead of duplicating the same data on their websites. Newspaper advertisements, companies are now required to publish only a QR code and web link for financial information. Detailed advertisement is now optional, right? And we will discuss these amendments in detail. Timeline for filing vacancies in board committees. So clear timelines have been defined. Vacancies must be filled within 3 months. With respect to related party transactions, significant relief has been provided, including rectification mechanism and exemptions. And uh, uh, and these exemptions, which will benefit retail companies and other companies. Timelines for disclosures relaxations have been introduced to ease the pressure on key personnel regarding the timely disclosure of financial information. So there is some relaxation being provided. Defined threshold for litigation or the penalties disclosures, and that have been introduced for a greater clarity. Right? Secretarial audit and auditors. So secretarial audits are now on the parity with on par with the statutory audit in terms of appointments. So this move strengthens the position of secretarial audits and aims to prevent the conflict of interest. Compliance officer now must be a KMP and can only be one level below the board of directors. So this strengthens the compliance framework across listed companies. We will also touch upon omitted provisions during this session. The the chat box is open for your questions, and we will address them as we move along. Any unanswered queries will be taken up during this Q&A session at the end. And the aim of today's session is not just to review the amendments, but also to understand their important significance in enhancing governance and compliance framework. Whether you are a compliance professional, compliance officer, corporate executive, or a legal counsel, this webinar is designed to equip you with the practical insights and strategies to ensure seamless adherence to SEBI's standards and these regulations. We are privileged to have with us Mr. Vivek Kumar, a renowned expert in corporate compliance and governance, to lead today's discussion. And let us make this session as engaging and informative as possible. Feel free to note down your questions and share your thoughts throughout the session. Without further delay, let's begin with our first topic. Thank you, and I hope you find this webinar enriching and insightful. Over to you, Vivek.
Thank you, Mayank. Good evening, everyone. And firstly, I should thank the entire Lawrbit team for doing a wonderful work in putting this together and bringing this seminar in front of you. So a great summary given by Mayank already. I'll straight away jump on to the amendments that have been prescribed under this one. They are effective from 12th of December 2024. So as we speak, most of these have been made effective. In case of any deviations, I will talk at the respective points. And in my one single line summary of this entire amendment is that though they are very, very subtle, but the impact has been very far reaching. So the typical example is right in front of in your screen. Earlier, it was an obligation and responsibility of the listed company that they had to fulfill all applicable laws in view of disclosures of interest, conflict of interest given by any KMP, director, promoter, or any member of the promoter group, or any other person dealing with the listed entity. Now, a parallel and equivalent responsibility is cast on these set of people. It is now their obligation as well, who will have to disclose their respective interest to the company, any change in interest to the listed entity. So earlier, in case of any mess, it was totally a responsibility of the listed company and also of the compliance officer as to why, and they were supposed to answer as to why this particular applicable law was not followed. Now it is an equal responsibility. It lies with the KMP also, it lies with the company and compliance officer also. In my view, this will be an ongoing disclosure that is required by any of these people. I don't think as per some industry discussions, whether it is a one-time or annual or what periodicity it should we should take a disclosure. In my humble view, it is an ongoing responsibility. Immediately upon implementation of this amendment, these people should confirm their disclosures by way of separate document or communication, signed document, or email communication, whatever it be. And as and when there is change, they should update it. And suppose there is no update during the year, I think the best practice for the compliance officer would be to seek an annual confirmation of the existing disclosures already made. So moving on to the next slide. I think for the corporates, we'll keep discussing as to what actionables does a compliance officer, company secretary, any other professional would need to take in respect of all these amendments that have been brought in. So we'll have to sensitize all the KMPs, directors, and people on which this particular amendment is applicable, that they have to make a disclosure. And the best way is to that compliance officer drafts a disclosure, a standardized template with the existing information on the board, and be sent for confirmation to the respective people. And the same template can be evolved over a period of time, or can be used for some for intimation of any changes as it comes along.
So, sir, is there any format specified by SEBI as of now?
No particular as of now, no particular format has been specified, and that is why I would recommend as a standard practice to every compliance officer is to create an internal template basis not only this particular clause, but wherever in IS LODR or any other regulations, Companies Act, LODR, there is any disclosure requirement by these people, they confirm it on a self-created template to the company.
Sir, we have received one question from our audience. So who are covered in stakeholder?
Yeah, please.
Who are covered in stakeholder?
Correct. So the stakeholders covered in this case are any KMP of the listed company, the directors, promoter, any person in the promoter group, and any other person having concern with the company. If you can go back to the previous slide, we will have the list of people who are covered under this one. Yes. So directors, KMPs, promoters, any member of the promoter group, and other person dealing with the listed entity. It can be any investor, it can be auditors, anybody. So broadly, anybody who has a disclosure to be made to the listed company in terms of what is their interest, in terms of is there anything which conflicts with the interest of the company in their role, what they are playing in the company. For example, if we have appointed an auditor XYZ and NLP Associates as the statutory auditors, but due to some other transactions, they come into a situation which is conflict of interest. So it is their responsibility and obligation to disclose to the company before company itself finds it out.
And should this information be disclosed as a one-time declaration or at regular intervals? And I suppose that there is no frequency defined by the SEBI.
Correct. This is an ongoing responsibility cast on all these people. So my standard practice suggestion would be that now that this amendment is effective, is notified, we should get a disclosure as a compliance officer of the listed company. We should get a disclosure from this set of people of whatever their existing interest or conflict of interest situation is, if the company is aware of them. And as and when there is any change, they should encourage this set of people to suo motu disclose to the listed company. And if there is no changes during the financial year, the best practice would be to at least refresh it every year.
Okay. And we have one more question, sir.
Yeah.
From Mr. Lakshmikant Gupta, whether this responsibility is also for subsidiaries of listed companies?
As of now, it has been cast only on the listed company.
Okay. I think, sir, there is one more question from Ms. Sheetal. Do we need to change policy of the company as per recent amendment in material subsidiary and website disclosure timeline? So I think we'll cover this later on.
Yeah, we will have these points will come up in the
Yes.
subsequent slides.
Right.
We have
Okay.
noted your question and
Mm.
we'll revert to it on the respective slide. Okay, so now Regulation 6, appointment of compliance officer. So again, a massive change, I would say, because of the clause number 3 that we are seeing on the screen. So we had already seen in the industry that any compliance officer was a qualified company secretary. Most of the cases I'm talking about, it was in the whole time employment of the company. And invariably, the company secretary used to play a dual role of being a compliance officer under the SEBI LODR regulations also. So being a company secretary, he or she was already designated as a KMP. Now the third point that we are seeing on the slide right now, one level below the board of directors, this will make a massive change in the industry. So right now we have seen enough number of times that the company secretary or the compliance officer is placed 2 level below the board, reporting to maybe CFO, reporting to sometimes say any other CXO. But now it is very clear that it has to be 1 level below the board of directors. So I'll cover the second 2 points a minute later. So the impact of this one is that we have to immediately, as a compliance officer of listed entity, we have to immediately inform our CXOs and the HR team of this particular requirement and how practically this can be ensured and how this can be effectively implemented. So such organizational changes at such a senior level are not very easy to come by, and we will see some development in the industry as we go along. So a very interesting change. Uh, the second part of the slide which we see here is any company which is under IBC, insolvency and bankruptcy resolution, and a resolution plan has been prescribed under the section 31 of the act, of that particular act. That particular company is required to appoint a compliance officer within 3 months. Also, under a separate amendment, that particular those sort of companies are required to constitute their entire board of directors as per SEBI LODR requirements within 3 months' time. So, moment resolution plan is approved, we have to appoint the full board as per the constitution prescribed and the committees thereof, and also have to appoint a compliance officer. So. There was a gap in the industry in this particular area, and that has been very clearly set in order. Till that time, till within those 3 months of time, if the company under IBC is trying to find its compliance officer and trying to set up his board, some other full-time key managerial person of that particular IBC company must manage the day-to-day affairs in the interim. So but effectively, the focus on compliance is gradually being strengthened. The position of compliance officer and company secretary is being strengthened. That's the objective of the amendment in our humble view. So the actionables in this case, as we already discussed, is to reposition the compliance officer, and this is already effective. So the amendment is effective from 12th of December. So we have to be on it. The
Sir,
corporates
I
must
have one.
take cognizance of this one. Yes, please. Yes, Mayank.
So I have one question, sir. So this compliance officers to be, full-time employment and designated as KMP. So what procedure may be followed for designate him as KMP, and should companies follow the procedure prescribed under Section 203 of Companies Act or pursuant to SEBI LODR? So, for example, if companies need to designate that compliance officer as KMP, so will they follow procedure as guided by the Companies Act?
There can be two scenarios here in this case, Mayank. The compliance officer under SEBI LODR regulations may already be a KMP and company secretary. In that case, I see only an executive action which is required here. Maybe the HR or the CXO or somebody from the board of directors, chairman or whom's managing director, they can make an executive order internally within the company, aligning a compliance officer to be reporting 1 level, to be placed 1 level below the board of directors. That's scenario 1. Scenario 2 is wherein compliance officer may not be a KMP. So in that case, we'll have to check all the boxes. is that compliance officer a company secretary, qualified company secretary? If not, we'll have to first find a person who is a qualified company secretary who can act as a compliance officer. he is he or she already a key managerial person? If no, it's second scenario we are discussing, it is no, then in my view, we have to follow the process as prescribed under Companies Act, appoint that person as the compliance officer, as the key managerial person. Level should be one level below the board of directors, and then that person can be appointed as compliance officer. And thereafter, we have to intimate, in my view, we should intimate to the stock exchanges that this compliance has been taken care. Anyways, under Schedule 3, it is mandatory in case of appointment or removal of any compliance officer as a KMP. So there, in any case, we'll have to inform to the stock exchanges within 24 hours of any action by the executive or by the board of directors. Obviously, when board of director in this case will act, it will act on the recommendation of NRC, Nomination and Remuneration Committee.
Okay, so we have one question from Ms. Ankita, and asking that, is this change of reporting of compliance officer to board for be required to be routed through NRC and BOD, so leading to a review of deliverables and the mechanisms for monitoring compliance performance?
Yes, it has to be routed through NRC, and then only board will consider it, because it is an appointment of KMP. So the NRC's mandate is to recommend appointment of inter alia KMP as well.
Okay. Sir, can the compliance officer reports to the CEO or CFO is not a member of the board of directors, but report and they are reporting directly to the board?
See, in my view, I'll qualify before saying any word. If the CEO is also part of the board of directors, that means he is an executive director and CEO, or a managing director and a CEO, he is part of the board. In that case, the compliance officer reporting to CEO can justify that he is one level below the board. So that can happen in my view.
Very quick, one follow-up question here. Usually, company secretary today reports to CFO, who also is most of the time part of the board or a KMP. Will that also qualify to be if the CFO is a part of board? Will that also qualify to be compliance officer reporting to the board, or it has to be a different line of reporting which has to happen? Because see, this is what my personal experience is. This is a global practice that CRO, we call a CRO, or we call a compliance officer. It reports to the board, but this is not the practice which we have typically seen in India.
Very pertinent point, Jyant. In my view, if the reporting of compliance officer is to the CFO, which we see very widely practiced in the industry, and if the CFO is also an executive director, so he is executive director and CFO, executive director finance, or whatever be his nomenclature, in that case, compliance officer reporting to the CFO should be counted as one level below the board, and it should be okay to go ahead with such kind of practices. And yes, you are rightly pointed out, globally, the practice of head of regulatory, head of compliance, company secretary reporting to the to somebody on the board of directors is a practice that is widely seen. And in India, I'm sure with such kind of regulatory push, and with the complexity or with the importance of governance that is flowing in from the regulator side, from the industry side, and from the corporate themselves are getting more responsible on the governance as we kind of are moving towards a more open economy and a more global economy. I'm sure the compliance officer position will be definitely strength in the time that we would like to foresee.
So, what is the timeline to fill the vacancy of a compliance officer for an entity not under the insolvency? So, can those entities, follow the same timelines that they have to fill that vacancy within 3 months?
Yes. So, while this particular amendment is only for companies under IBC, but that gives a clear indication that compliance officer's position should be filled up within 3 months timeline.
Sir, we
So
got one question from Mr. Bipin.
yeah.
What are the designations or reporting criteria to become a one-level officer below board of directors? Can the deputy vice president become a compliance officer?
See, vice president, deputy vice president, assistant managers, senior managers, general manager, these are all internal nomenclatures. So while the idea is whether the person internally has whatever position, he should be one level below the board of directors. So you can widely see in the industry the set of people reporting to the board of directors or who are one level below the board of directors. They may range from say rank 1 to rank 3 or rank 4 or 5 also. So I think rank is immaterial internally, but that depends upon various other factors also. But one level below the board of directors, that's why the regulator is very specific and very clear. It is not specifying any particular designation which is fancy or which is not fancy in the industry. It is simply saying that it should be one level below the board of directors.
Thank you, sir.
Yeah. So coming on to regulation number 17, wherein some interesting changes have been brought under the board of directors, this one. So amendment relating to appointment of board of directors include that the non-executive director who is going to attain the age of 75 years, it is now very clearly prescribed that prior approval of shareholder is required here. Suppose we have I will understand this with an example. Suppose there is a non-executive director on our board who is appointed till the tenure of say 2026, but in the present year 2025 he is going to turn 75 plus. So now we have to take a prior approval, since Companies Act prescribes that anybody above the age of 75 years requires special resolution to be passed by the shareholders. So in this case we will have to seek prior approval of the appointment. So before his turning to 75, we need to seek shareholders approval. That's one. Earlier the practices, we had seen varied type of practices in the industry till after 2026. In 2025, in our example, the non-executive director has already done 75 years of age. In 2026 his term ends. If suppose there is a proposal to increase his tenure in the company on the board, then they would approach for shareholder approval before the appointment, or the board will appoint already and then in the coming general meeting they will propose their confirmation to the shareholders. Now it is very clear that before appointment only you will have to seek prior approval of the shareholders. So all those companies, one of the actionables in this case would be that we'll have to see the age of the non-executive director, which is there presently, and the age of and their end of tenure. Okay, so if before the end of tenure they are turning 75, we need to do necessary compliance of seeking prior shareholder approval. In the Companies Act, which I mentioned, it was applicable under Schedule 5 to only executive directors. Now, non-executive and executive, if they are getting 75 years or above, the mechanism of shareholder approval is prior, and it has brought in par with each other. There are certain exceptions prescribed. Directors nominated by any financial regulator or a court or tribunal, they are exempted from this particular prior approval requirement, which is obvious and makes sense. Appointment of a person on the board of director or as a manager, if such appointment requires any regulatory approval, then the time required to seek or secure that regulatory approval will not be counted within the 3 months timeline. Another important update is that if there is a vacancy in the committee of the board of directors, suppose there is a rejig of the committee or any director retires during the year, and though the composition of board fulfills the requirement of SEBI LODR, but any committee's composition is not fulfilling the requirement of LODR, now the board will have to take a proactive action, and within 3 months or before the vacancy happens, whichever is earlier, it has to reconstitute the committee and make it fully compliant with LODR regulations. So the rationale of these amendments are clear that the governance standards are being improved wherever possible, and wherever the company is aware that any specific kind of approval is needed or any specific proactive action is needed in terms of recomposition of the committee, then that fact is known to the company beforehand. So the company is expected to act on it beforehand and not after kind of end of tenure of that particular director or after the vacancy is created. We have to take prior proactive actions. I think a welcome change. So as we discussed, we have to analyze the age and tenure of the board of directors and seek prior approval wherever required. We may also alter or update our appointment and remuneration policy, KMP and directors appointment and remuneration policy. If there is any vacancy in the committee of the board, then the company has to take immediate action to reconstitute the committee and make it fully compliant, because this amendment is already effective from December 12th, 2024. So Mayank, do let me know if there are questions. Otherwise, I'll keep
Sure,
running
sir.
on the slides.
Sure, sir.
So under related party transactions, very important changes, mostly welcome changes, and mostly making our life easier. So there are certain transactions which has been exempted from the purview of related party transactions. Like if a person is an independent director or a director with any bank, then opening of current account or saving account with those particular bank will not be treated as a related party transaction. However, interestingly, fixed deposits are not covered here. So if such person needs a fixed deposit services, it will have to shift to some other bank. For current and savings, they can continue. Any interest paid on such accounts will not be a related party transaction. Second point is a big relief to the retail companies, listed companies who are into retail business. If they do any transaction with the director or employee of the listed company or director or employee of the subsidiary of the listed company, any director or employees of the listed company or its subsidiary has any transaction with the director and employees of the listed company, in that particular case, it is not treated as related party transactions. I'll just repeat this point to make it clear. So if there are any retail purchases from any listed company or its subsidiary, I'll take one example, say for example, any retail company, XYZ Retail Limited. XYZ Retail Limited has a subsidiary Retail Limited. So if the director or employee of XYZ purchases any goods from XYZ or subsidiary, then this is not a related party transaction. Any discount given to such director or employee will also not be treated as related party transactions. However, such purchases or discounts should be such that it is available to anybody who would like to transact with that particular retail company. So earlier, it is a big relief in my view, because there used to be a very complex mechanism. If suppose a director of a retail company goes to a particular retail shop, buys something, invariably we punch in their data, and it flows down to the ultimately to the statutory accounting team. And when they get to know that this related party transaction has happened, so they were onto a run to make it compliant. There were systems which were built that their POS, point of sale at the retail place, was robust enough to identify related party compliances and then report it to the company for necessary compliance. And there was a kind of unsaid obligation on the employees and directors that they do not do retail purchase with such particular XYZ or subsidiary companies. So it was a bit of a complex environment, which has been thankfully eased. The third point, which has been exempted from being a related party, any corporate actions. Earlier, this was applicable only for the listed company. Now, it is applicable to all companies. So any corporate action like dividend, issue of bonus shares, rights shares, buyback, consolidation of shares, subdivision of shares, any corporate actions like this by any entity is not treated as a which is applicable to all the shareholders equally, will not be treated as a related party transactions. Example, suppose a subsidiary of a listed company, say subsidiary limited, declares dividend and dividend is paid to XYZ Retail Limited. I'm taking example of retail, it can be any company. It gives dividend to XYZ Retail Limited. Then this dividend declaration is not a related party, though the transaction is happening between holding company and subsidiary company. For that matter, be it any joint venture company, be it any associate company, in all such case, the corporate action is uniformly, it's not a favor or a benefit given to the related party. It is equally available to every shareholder. So that way it is not treated as a related party transactions. So the rationale behind this one is obviously to ease the business, and current account, savings account, these all are regulated by RBI. By opening an account of the director, the bank is not doing any specific benefit to the director. And retail purchases do not create a business relationship between the legal entity listed and the director of that particular company. So these are the basic rationales behind giving relief to this one. And there are
So want to ask one question with respect to this. So is a if director has that fixed deposit that so director needs to disclose that interest earned from that fixed deposit to the listed entity or to the stock exchange?
yes, so that will continue to be a related party, and unfortunately. And in the entire compliance cycle which is required for the related party transaction, prior audit committee approval, if it is significant, then it will go up to the shareholders for approval. So all those things will be applicable.
Okay. And so we have one question from Rajeshwari. If listed company have current account with bank and bank is related party to listed company, as per recent amendment, it excludes as RPT. So the current account transactions like payment to vendor, collection from customer are not RPT as per recent amendment.
Yeah, I think that will be exempted. See, the bare regulation says that acceptance of current account deposits and saving account deposit by banks in compliance with the directions issued by the Reserve Bank of India or any other central bank in the relevant jurisdiction from time to time. So this simply means that bank getting into a savings account opening mode or current account opening mode with any related party. This one is not limited to directors or employee of the bank. It is applicable to any related party. So it is available. This particular exemption is available.
Sir, if any director or promoter purchasing any material or taking any service for business purposes from the retail stores, so will that transaction count as RPT? Not for his personal consumption.
See, till the time it is a retail purchase, and till the time the terms of purchase, terms of purchase in any retail shop would be the price. It is not a special price given to that particular director or employee. If it is a price which is uniformly available, applicable, and offered to all, then it is not a related party transaction. It will be purely a retail purchase, and that will be out of the scope of related party transaction as we speak.
Yes, sir. Thank you.
Okay, the pleasure. Remuneration and sitting fee for directors, KMP, and senior management. This has been done away, though this continues to be a related party transaction, but prior audit committee approval is no longer required. The rationale for this particular amendment is these payments are already under the review and scope of NRC and the board. Okay, so an additional layer of approval by the audit committee is not needed. So it is already passing through two magnifying and two filtration process. One more filtration process of audit committee has been removed. However, If such director, KMP or senior management person also is part of the promoter or promoter group, then this third filtration process will continue to remain. Audit committee or approval will be required. Okay, so only to those KMPs, directors, or senior management who are not part of promoter or promoter group, for though any remuneration to be payable to them, to be paid to them, you already have NRC and board approval, so additional audit committee approval is not required. Okay, uh, and and another layer has been added on this one is that the, the payment should not be a material transaction, meaning to say whatever materiality threshold we have prescribed, if it is exceeding the materiality threshold, then yes, audit committee's role will kick back in, but otherwise it will not be required. NRCs and board approval is sufficient. So meaning to say all non-material remuneration paid to directors, KMP and senior management, NRC and board approval is sufficient, audit committee not required. But if it is material, audit committee additionally is required. If that person is part of promoter group, additional audit committee approval is required. Okay, and in the last box that we say, payment of statutory dues to central or state government, transaction between two PSUs, transaction between a public sector company and the government, all these transactions, wherever if it falls within these three bullet points, then even though it is material, approval of shareholders has been done away with, because government says that I can regulate myself. This is not a private enterprise. These are central and state government companies. These are PSUs. And the transaction is between the PSU, government, state or central, whatever it be. Then we can regulate ourselves. We can take care of the governance requirement, and shareholder approval has been done away with in this case. Material transaction or immaterial transaction does not matter. So there are certain, in the previous slide, we saw some ease of doing business measures. These are more something I would say as streamlining measures. There was no scope of prior approval earlier in LODR for any related party transactions. But now a concept of prior approval has been fit into LODR, has been brought into LODR. So it makes the approval process at par with the Companies Act. But there are certain conditions which are very important to note. The value of such related party transactions should not exceed 1 CR, 1 crore Indian rupee. It should not be a material related party transactions, meaning to say in smaller listed companies where even 1 crore value is above the materiality threshold, then basically you have to see the lower of the either one, either 1 CR or materiality threshold, whatever it is for you. The related party transaction should be below it in order to be qualified for going for a ratification, post-transaction ratification. So the third condition is while approaching the audit committee for a ratification of already done transaction, a rationale needs to be provided as to why we are going for a ratification, why the company could not put it as a prior approval matter. Okay. And this disclosure of such ratified related party transaction is to be done in the next filing that the company does for the related party transaction, saying that this has been a ratification case. Again, this would largely fall under ease of doing business measure. And the next one is related to this one. In case the transaction is brought up to the audit committee for ratification, but audit committee does not want to approve it, then such transaction will become voidable at the option of the board. So audit committee will make a recommendation to the board of directors, and board will take a call on making the transaction voidable. Suppose the transaction is made voidable, then directors responsible for such related party transaction will have to compensate to the company on such related party transaction. So while this is presuming that there would be some loss in the related party transaction, which the director will be required to compensate to the listed company, the responsible directors, I wonder what if there is a profit. So will that profit be undone? Will that profit be refunded to the related party? the transaction, I don't know whether if it requires to be undone, how will it be undone? Or in the best case, if it is a profit case, I will presume that audit committee will ratify it. It will not send a recommendation to the board for making the transaction voidable. So the last table that we see on the screen is that this is an additional channel of approval that has been prescribed. So earlier what was required was all material related party transactions which a subsidiary enters into, it was supposed to be brought up to the audit committee of the listed holding company. Now, instead of bringing these transactions one by one as they occur or as they are proposed to be entered into, the holding company which is listed can approve the related party transaction of subsidiary as a omnibus approval. Obviously, all requirement of omnibus approval must be fulfilled. So audit committee can approve the transaction of subsidiary, related party transaction of subsidiary as an omnibus approval. So suppose the omnibus approval are typically taken at the beginning of the year or once in a year, whatever periodicity company fixes. Suppose there is no omnibus approval that was taken, then the existing mechanism of approval is already there. If the transaction is proposed to be entered, it can be brought at that particular audit committee. Before that transaction happens, it can, in the previous audit committee meeting, it can be brought for approval. So the very important actionables, I think one of the first internal customers of the compliance officer and the company secretary is the finance team. We need to have a detailed discussions with the finance team on the exemptions that we have, on the additional mechanism of omnibus approval for subsidiary companies that we have, and all other relaxations that we have. And this can be discussed, and an SOP, if the company has, needs to be updated. And the RBT policy also can be amended depending upon how each listed entity has framed its RBT policies. If required, we should go through the RBT policy carefully in detail, and any amendment, if it is required, should be made and put up to it at the next meeting of the audit committee and board for approval. So this is effective already. December 12th, 2024, this has been effective. So the audit committee meetings and the board meetings that we'll see for the Q3, quarter ended Q3, we will see such type of items creeping into the audit committee agenda and board agenda. So Mayank, if no questions on these matters, we can move on to the next slide.
So we will take the questions at the end.
Yeah. So a deep impact amendment that has come in. Secretarial auditor has his appointment, his position, the process of his appointment, his or her appointment has been brought absolutely at par with that of the statutory auditors. So what I mean to say is that the eligibility criteria has been prescribed. A secretarial auditor must be a peer-reviewed form. Either an individual form or form of more than 2 or more people. So if it is an individual form, they have to be appointed for a term of 5 years. Okay, and so this is effective from 1st of April 2025. So please note here, this is effective 1st of April 2025, and in the AGM of 2025, whichever listed company does, we will see a definitive item under a special business, that is appointment of secretarial auditor for a term of 5 years. So can existing secretarial auditor be appointed for 5 years? Yes, he can be. Even if whatever period he has served, even if he has served 1 year till 31st March 2025, for the year ended 31st March 2025, whatever period of service he has given as secretarial auditors, whether it is 1 year, whether it is 15 years, or whether it is 20 years, irrespective of that, he can be appointed in the AGM of 2025 as secretarial auditor for the financial year starting from 1st of April 25 till 31st of March 26 plus 4 years in one go. It has to be appointed by the shareholders at the annual general meeting, no other general meeting, but only annual general meeting. Is the secretarial auditor eligible for reappointment? Yes, a second term of 5 years is also permitted, again with the approval of shareholders at the AGM. But in that case, it should be a form of company secretaries. Individual cannot be appointed. After 10 years, there is a cooling off period prescribed of 5 years. Okay, and as we discussed, that approval of shareholders is required for appointment, and that means for removal as well. So suppose during the tenure of 5 years, there is a need to kind of remove the secretarial auditors, then also it's approval of shareholders who is required. So this gives a lot of responsibility to secretarial auditors, gives them a lot of independence. So with independence comes responsibility. Now they are under no longer a professional fear that if they report adverse matters, they may not be continued in future. Though as a secretarial auditor, anyways, it was expected of them. But practically in the world, in the business world, we know that people not only want to report it fairly, but also want to have a continued business sense. So they can report freely in case there is a observation or remark or any adverse opinion, they can make it freely. And there has also been disqualification that has been prescribed by SEBI. Okay, though, and these disqualifications are at par with what has been prescribed with statutory auditors.
So just to want to get one clarity, that can we appoint a secretarial auditor for less than 5 years?
No, it has to be a term of 5 years.
Okay, thank you.
Like for statutory auditors, the statutory auditors cannot be appointed for a term less than 5 years. Same for secretarial auditors. So you see the impact of such amendment, Mike. One, the secretarial auditor is reasonably sure that his term is for 5 years. That gives him a lot of power and independence, and that gives him a lot of responsibility. He needs to do a thorough audit and make an absolutely fair and transparent report to the shareholders. Earlier, the report of the secretarial auditor used to be addressed to the board of directors. Now it is addressed to the shareholders. Though it is not, this is my understanding. It's not very clear in the regulations, but since the appointment is made by the shareholders, obviously it makes sense that the report be addressed to the shareholders. This is a quantum shift from the existing practice.
So, sir, whether Section 144 of Companies Act becomes applicable to secretarial auditor as well, that states auditor not to render certain services.
Right. So, Companies Act very clearly says that those provisions of Section 144 is applicable on the auditor of the company, and auditor is defined as any auditor, whether it is statutory financial auditor or it is secretarial or the internal or it is cost auditor. So I'll presume that it will apply to the secretarial auditor with equal force, and parallelly LODR also recognizes the same concept what is there in Section 144. Internal, it has given a specific list of prohibited service which secretarial audit cannot provide to the listed entity or to its holding company or to its subsidiary company. We see on the second box on the screen, which is internal audit, design and implementation of compliance systems, policies and processes, investment advisory, investment banking, any outsourced compliance management or record keeping work, any management services. These all are prohibited to be given to the listed company.
But should that secretarial auditor, provide the certification services to that company?
Ideally, no.
Okay.
In my view, ideally no, because see, these statutorily these forms are not required to be. I'm sure you are talking about the pre-certifications of the forms that is required to be filed to the Ministry of Corporate Affairs. So ideally, any independent company secretary is required to pre-certify them. If as an auditor, I am myself pre-certifying and I am myself kind of auditing these pre-certifications, people may have, specifically practitioners may have a totally different view, and I take their view with full respect and with full rational. But in my personal view, this should be separated. In order to be, see, obviously we read the basic concepts of any internal control mechanism is maker and checker should be separate, maker checker concept. So that way the forms, though the maker can be said, it can be said that maker is the company and then secretarial auditor is the checker. But in my view, pre-certification and the audit form should be different.
Thank you, sir.
Yeah. Yeah. And the first box, what we'd like to see here is that it is specifically now mentioned that not only the secretarial, in addition to the secretarial audit, the compliance report should also be signed by a peer-reviewed company secretary or by the secretarial auditor himself. And this is effective from 1st of April 2025. So very strong position given to the secretarial auditors now. Even the quarterly secretarial compliance report has acquired a lot of importance now. It was earlier also important. We cannot say that it was not important, but gradually the weight is increasing day by day. So a big actionable here is that the company needs to keep the time frame in mind, that is of 5 years. Accordingly, identify a suitable secretarial auditor. In the audit committee meeting or board meeting, which is happening for Q3 or which will happen in the near future for the year end FY25, therein we need to put the proposal to the audit committee. Audit committee, as per its mandate, will review the proposals, interview the potential secretarial auditor, and make a recommendation of a name to the board of directors. And board of directors will make a recommendation to the shareholders. And whenever the annual general meeting in the financial year FY25 will be convened, one item of special business we will see in all listed companies is to appointment of secretarial auditor. There are certain disclosures which has been made mandatory to be given in the explanatory statement. So I would request my fraternity to go through that carefully and bring out those disclosures in the explanatory statement. Plus, there is one more addition to the one more amendment which will impact all explanatory statement. For any business which is a special business, there has to be explanatory statement. In that explanatory statement, the board of directors must put up a rationale of why this proposal is being brought in. What is the rationale of this proposal? That rationale the board of directors has to bring in. It has to be mentioned in the explanatory statement. So these important flow of events has to be choreographed. It has to be brought into the SOP of each compliance officer, and accordingly in the notice of the coming annual general meeting we'll have to take care of this one. So that is one important to do for corporates. We'll have to start acting on it from now onwards. So again, this there are certain disclosures to the stock exchanges that we make periodically. After every board meeting, there was a mad rush within the compliance officer and the compliance officer's team to file all the disclosure, outcome of board meeting, financial results, and the press releases, everything within 30 minutes. Now, if the board meeting has ended at a time which is 3 hours away from the next trading opening the next trading day, in that case, the compliance officer has full 3 hours to make that disclosure. So if the board meeting suppose ends after the trading hours, which is 3:30 is the end of trading hours. If the board meeting where the financial results have been approved ends at 3:31 p.m., let's presume, then from 3:31 p.m. till 3 hours, 6:31 p.m., the company has all the time to file its outcome of board meeting, financial result, everything that has to be that is supposed to be filed after the board meeting concludes can be filed within 3 hours of time. So big relief. I think this will bring in a lot of quality in the disclosure. However, if the board meeting concludes at a time which is within the normal trading hours, then within 30 minutes, we'll have to be making all disclosure to the stock exchanges. The rationale for this particular amendment is that now the information systems are pretty quick, and if the stock exchange is opening the next morning, even if you make disclosure after 3 hours or within 3 hours, there is sufficient time for the stakeholders, for the shareholders to grasp the information, to spread the information. There is sufficient time. The amount of time required to absorb the information is more than sufficient. Okay, and the next disclosure relief that has been provided is on non-tax litigations. Suppose there is a litigation on the company, any claim that has been made on the listed company, and it can be disclosed to the stock exchanges within 72 hours. So right now, before the amendment, we had 24 hours to make that disclosure. It is now increased to 72 hours. So it allows the compliance officer and the relevant team within the listed company to evaluate the litigation, whether it is a material litigation or not, whether this needs to be disclosed to the stock exchanges or not. So the impact of the claim made on the company under the litigation, there has been sufficient time given to the company to make a complete evaluation, and they then make a disclosure to the stock exchanges. However, here in this case, we will have to make a SDD entry. So SDD entry means to say, if on the first evaluation, prima facie, if this non-tax claim litigation against the company is presumed to be a unpublished price sensitive information, then within those 72 hours period, the team involved into evaluating whether this is material or not, or what to disclose, what not to disclose, the minimum information anyways has to be put in. The team will be under a obligation under prevention of insider trading regulation that they cannot share this information with anybody except for legitimate purposes. In tax litigation purposes, this has to be disclosed only if it is material. So it has to be disclosed within 24 hours if it is material. If it is not material, at the end of every quarter, we'll have to disclose it. And same goes for non-tax litigation also. If it can be disclosed on a quarterly basis also if it is not material. Now coming on to acquisition, the threshold has been increased from 5% to 20%. So acquisition of 20% or more of the shares or of the voting rights of any other company, only in that case such disclosure needs to come in within 24 hours. And if the listed company already holds some shares in the target company, and in the change of movement is more than 5%, only then it has to be disclosed within 24 hours. Otherwise, it can be all such acquisitions can be clubbed in together, and at the end of the quarter, whatever is below 20% in case of fresh acquisition, what is below 5% in case of creeping acquisition of the target company, it can be all clubbed together and given as a quarterly disclosure. So in the previous companies LODR Amendment Act, which came into 2023, which had again a very quantum shift in terms of the governance standards, few additional clauses were brought in under Schedule 3, which made it a deemed material event which listed companies were supposed to make a disclosure to the stock exchanges. One of these deemed material events was any fine or penalty levied on the listed company. So this had brought in, there was no threshold prescribed, and any fine or penalty was deemed to be material irrespective of its value. So this had resulted into a huge compliance burden. Plus, it had also resulted into some interesting disclosures made to the stock exchanges, wherein a penalty of even 1,000 rupees was being reported. So to do away such a gap between the understanding of the industry and the expectation of the regulator also, I think a very sensible amendment has been brought in. If there is a fine or penalty imposed on the listed company, And if it is imposed by a sectoral regulator, then it has to be disclosed within 24 hours only when the fine amount exceeds rupees 1 lakh. And if the fine or penalty amount is imposed by any other authority, then it has to be disclosed within 24 hours only when it exceeds rupees 10 lakhs or more. Okay. So meaning to say, only a material fine or penalty needs to be reported within 24 hours. Otherwise, all such fines and penalties can be clubbed in, put into one disclosure, and that can be reported to the stock exchanges once in a quarter. So now, an interesting thing here is what is sectoral regulator and what are other authorities. So regulator, in my view, I think there are enough resources available online on the web also with full justification of who the regulators are. So for a telecom company, TRAI will be regulator. For an airport or airline entity, AERA, Airport Economic Regulatory Authority with the regulator. So RBI, any company dealing in foreign exchanges, RBI is one regulator. Ministry of Corporate Affairs, in my view, will be regulator for every company. SEBI would be regulator for all listed companies. SEBI, and then on behalf of SEBI, BSE and the stock exchanges have been taking action. The stock exchanges would be a regulator for any listed company. Plus for banks, RBI would be a regulator. So we have to identify very carefully for each entity. The compliance officers should carefully identify what are its regulator, or upon each instance of any fine or penalty coming in, at that particular point of time, the compliance officer can identify whether it is by a sectoral regulator or whether it will fall under the category of any other authority, and accordingly make disclosure to the stock exchanges. Now, we have seen, as we have spoken, we have seen the rationale of this particular amendment that has come in. For the tax litigation and non-tax litigation, the tax team within the company and whosoever deals with non-tax litigations, whether it is legal, whether it is business relations, whichever team looks after the non-tax litigation, they need to be sensitized, and they need to be given a breather. See, now you have given an additional timeline. You have given a responsibility to do some additional checks whether the litigation is material or not, and only then we'll have to make a disclosure. And this should go in tandem with the compliance officer, because suppose while the litigation, whether it is tax litigation or non-tax litigation, it is under evaluation of how to make a disclosure or when to make a disclosure. During that period of time, there has to be a SDD entry under PIT guidelines, Prevention of Insider Trading Guidelines. That has to be done. So it has to be done in close collaboration with the compliance officer and the respective team. Yeah. So, and whosoever deals with the entire business team or team on the ground or team who is the first team to receive the penalty notices or anything else, they need to be sensitized that see, moment you receive any notice which is more than 1 lakh, they need to immediately report to the compliance officer. So I think there is a debate within my peer group also as to how to sensitize our business team that whether you should let me know when it is exceeding 1 lakh or whether it is exceeding 10 lakh. At what threshold they should let the compliance officer know. In my view, the standard instruction should be that anything which exceeds 1 lakh should be reported to the compliance officer. It should be on the responsibility of the compliance officer and the CXOs. Obviously, the exercise be led by the compliance officer to determine whether this fine or penalty is by a sectoral regulator or any other authority. So that way, at one particular time, one particular place, at one particular table, and that is compliance officer or any other CXO responsible, at that place of time, the decision is being made whether it is sectoral regulator and whether it has to be disclosed to the stock exchanges or not. Okay. Let's jump on to the next slide.
Sir, is there a need to amend the materiality policy?
Material property in terms of tax litigation you are talking about?
Yes, in terms of these disclosures, for example, tax litigations, penalty disclosures, or non-tax litigations, should listed companies, amend their existing policy, or that existing policy will suffice?
Mike, in my view, there is no need to alter the materiality policy as of now, because materiality threshold has not been tinkered with. So whatever was prescribed in 2023 amendment, that continues to be in place. Only that in tax litigation, we have to make a judgment whether this is material or not. So in my view, the policy on materiality does not require a amendment as of now.
Thank you, sir.
Okay, next. Yes, and I think Mayank at the introduction of the session only mentioned that there has been integrated filing, which has been introduced by the regulator. Expert committee and the industry was discussing this and kind of proposing this to the regulator since a long time, and now we see the light of the day. So there has been integrated filing which has been introduced. These integrated filings can be practically distributed, and under the regulation also can be distributed into two branches. One is governance related filing and another is finance related filing. So we have to file it at one integrated platform. These filings now no more are required to be filed to both the stock exchanges separately. So under governance related filing, one is the statement of investor grievances has to go through in the integrated filing platform. The corporate governance report will also go in. There has been formats prescribed under the circular of 31st December 2024. The financial related filings are the related party transactions disclosure, the quarterly disclosure of outstanding defaults on loans. The third one is fourth one is most important, the quarterly financial results. And another one that is covered under financial related filing is statement of deviation and variation. Okay. So these things have been brought under integrated filing. The actionable, in my view, in these cases are that the compliance team, the compliance officer in its team needs to familiarize itself thoroughly with the integrated filing platform. And since these are already implemented, we have to be, the timeline has been increased for all these filings, which has made now 30 days from the end of the quarter. So earlier for these filings, it was 21 days from the end of the quarter. So I think additional time has been given in order for everyone to grab up with the integrated platform, and we'll have to be fully familiar and make necessary filing within 13 days of the end of the quarter, which is by 30th of January 2025. We will see a lot of filing happening through the integrated filing platform by many companies. So the rationale is very clear to all of us that it eliminates the need of filing the same document across multiple stock exchanges. So one filing will suffice. Anyways, the time that has been provided to the compliance officer and team has now been increased, but anyways, dual filing is a duplication of effort, and one integrated and ease of doing business demanded that there should be an integrated file platform for filing. Yeah, so as we discussed, we need to familiarize ourselves with the integrated filing platform, and the new formats have been prescribed. There are additional information requirement. So rather than waiting closer to the compliance date, we must start preparing these new formats, the reporting in new formats, and then I think makes sense to file at least 6 to 7 days in advance, so that if there is any glitch, that can be rectified well within the compliance timeline.
And even both stock exchanges are working on building the pending APIs also, sir. So they have introduced couple of APIs like for investor grievance, corporate governance, and reconciliation voting results. And I think in the month to come, February, March, they will also introduce APIs for related party transactions, secretarial compliance report, and statement of deviation. So maybe by end of March, the integration work will be completed, and the single filing and integrated filing will be more mature by that time.
That's a great update, Mayank, and I hope to see all of this falling into place by 31st of March. So there are certain additional disclosure requirement that has been prescribed for the website of the company. Number one is memorandum and articles. I think absolutely makes sense. These are the basic charter documents of the company. While it is deemed that these are publicly notified documents, but anyways, if anybody has to access this document, they had to approach to the website of MCA, pay a small fee, and download the document, which was cumbersome. Since these are documents which anybody dealing with the company is expected, or it is presumed that they have read and understood it. It makes sense that these are available now. The times have changed, and in fact, it has changed long back. Any company does business through its website only. So memorandum articles being on the website is absolutely must thing, which has now come up in the regulation also. The profile of directors was already there on the website. Now we have to additionally disclose the full-time positions in any other body corporate that the director holds. So slight amendment required. Third point is employee benefit schemes. So all ESOP schemes or any other scheme which forms part or which falls under the purview of SEBI's share-based employee benefits and sweat equity regulations. So any scheme falling under these regulations, SBEB regulations, as we call it in short, they will have to be displayed on the website of the company. Obviously, there are certain exclusions. The commercial secrets can be blanked out. Any detail which adversely impacts the competitive position of the listed company can be blanked out. And this blank out can happen only with the approval of the board of directors. So as a compliance officer, we will have to justify to the board as to why these commercial secrets and why these clauses which may affect the competitive position of the company is being blacked out. And the blacked out position, the version which will be put on the website of the company must be approved by the board of directors. And after board approves it, only then we can put it on the website. So if there is no blackouts required in such schemes, the compliance officer can immediately go ahead and display it on the website, put it up on the website. So in the quarterly earnings call, as it is popularly called, the listed companies were by default into a practice that they used to notify the stock exchanges at least 2 trading days in advance. Then before or closer to the earnings call, the presentation to be used in the earnings calls was reported to the stock exchanges. Most of the case before the earnings call, and in few cases we also saw the presentation coming up on the website post the earning call, immediately after the earning call. So now it is very clear that you intimate to the stock exchanges 2 trading days in advance, upload the PPT of the earnings call before the start of such event, and then after the event, whatever compliance was required, like video recording of earnings call, it has to be uploaded within 48 hours. Audio and video recording of the investor call should be available on the website of the company within for a period of 2 years. Sorry. And it has to be internally preserved for a period of 8 years. And the transcript to be available with the company on the website for 5 years. Okay, so these are some subtle changes that has happened in the investor earnings call related provisions in Schedule 3 and Regulation 30 read together. I think the last is one of the most important ones, wherein the listed companies where it was mandated to the listed companies that they disclose to the stock exchanges any agreement wherein the shareholders were involved, the promoters were involved, any related parties were involved, any director, KMP or employees were involved, and such agreement had the effect of impacting the management or control of the listed companies. Under the 2023 amendment regulations of SEBI LODR, these were mandated by the listed companies to be disclosed to the stock exchanges. Now, additionally, such agreements which affect the management or control of the listed company, they have to be summarized and mentioned in the annual report, and a web link has to be given of the website of the company where complete details of such agreements are mentioned. So, meaning to say, disclosure to the stock exchange was already prescribed 2 years back, 1.5 years back. Mentioning in the annual report has been prescribed now of the snapshot of such agreement. Details of such agreement has to be hosted on the website of the company. So we'll have to act in reverse order. Details of such agreement we'll have to put on the website immediately. In the next annual report, we'll have to mention a snapshot and refer to the website, refer to the web link in the annual report where complete details are mentioned. So these things we'll have to do immediately if there are such agreements. So now, what does complete details mean and what does snapshot means? It is left to the judgment of the listed company. The compliance officer and the board of directors have to act in fiduciary capacity, exercise their judgment. And what does complete detail means has to be what does snapshot means and what does complete detail means. They will have to judge and make accordingly disclosure on the website and the annual report. So I think compliance officer and its team has to immediately connect with the respective company's IT team or whichever team maintains the website of the company, arrange for the necessary disclosure on the website where as per suitability wherever this information is required to be put up. Memorandum articles, profile needs to be updated. For ESOP scheme, there are certain clarifications which we still await from SEBI. So till the time such clarification is in place, we can I think we can upload the ESOP. We must, in fact, the compliance officer must upload. So while further clarity, when it comes, it can be amended or modified or updated suitably. But as of now, the obligation is there already on the compliance officer to put the ESOP schemes on the website. Agreement needs to be suitably detailed, needs to be suitably made a snapshot of for the usage on website and on the annual report. So these are effective from December 12th, 2024. And I think immediate actions are warranted with the compliance officer on all such steps. Yeah, these are some very welcome cost-saving measures, ease of doing measures that has been brought in. Any annual report, wherever we were supposed, as a compliance officer, we were supposed to distribute the annual report to all the shareholders who had not provided their email IDs. Now, instead of sending them the annual report, these sending used to be very expensive. Printing and sending used to be very expensive. Instead of sending the annual report, we can simply send them one letter, give them the web link of the website of the company, wherein the detailed annual report they can refer to. So that should be sufficient compliance. There are many newspaper advertisement which were required to be published. So any notice that we used to give to the shareholders, it was a mandate to publish it in the local newspaper and the national level circulated English newspaper. So again, this was a huge cost. This has been done away with. Such newspaper publications are no more required. The rationale of this amendment are straightforward and simple. Now the reliance of print media on circulating the information has gradually diminished. Any information available on the website, on the stock exchange, is a sufficient method of stakeholders absorbing such information. Print media, visual media social media has been very strong in conveying these measures to be taken by the listed company for their stakeholders. Now the quarterly financial results. Earlier, the quarterly financial results used to be published into one national level newspaper and one regional language newspaper. Now the financial results can be put up on the website of the company or of the stock exchange, and a QR code upon scanning, we can be directly redirected, or we can be taken to that particular web page where the financial results of the company is hosted. And publishing that QR code in the newspaper is a sufficient compliance. So I think this is a very easy mechanism that has been given to the companies. We can put the financial results on the company's website. We can copy the hyperlink. There are enough number of tools available online, which are free tools, and they can convert any web link, any hyperlink into a QR code. So through those QR code generators, we can generate a QR code. download it and provide it to our press guy, and they can arrange to put that QR code on the newspapers. So moment any stakeholder or shareholder or any other person interested in the financial results of the company will scan the QR code through their smartphone on the newspaper, he will be redirected to the page wherein the financial results are hosted. So this is the way world is moving forward. They are moving forward on QR codes and rightly brought into the regulations also. I think a very brilliant move. This reflects that the regulator is thinking very. The regulator has been very dynamic, thinking as per the times and thinking with the latest trends. So this not only brings ease of doing business but also reduces the compliance cost. So I think the compliance officer as a preparatory measure can keep ready then the QR code, the matter that needs to be published in the newspaper along with the QR code, the content of the letter which will be required to be sent to the shareholders, giving the web link of the annual report. These things can be kept ready and prepared as and when required it is to be used. And I think compliance officer can also relay the good news that they have reduced the cost of compliance for the company. Another important actionable that we can do. There are some provisions which have been gradually going redundant. So we'll in the next slide also see which provisions have been totally deleted. Herein we are seeing the provision which has been the advance intimation of which has been brought down from 7 days to 3 days, 3 working days. So for record date, earlier we were supposed to provide an intimation to the stock exchange 7 working days in advance, but now it has been condensed to 3 working days in advance. However, if such record date is for the purpose of any corporate action, dividend, bonus, rights, consolidation, consolidation or reduction of share capital, then such record date continues to be we'll have to continue disclosing it 7 working days in advance. So no relaxation in that particular timeline. So earlier the gap between 2 record date could not be less than 30. Now it has been brought down to 5. So the gap between 2 record date cannot be now less than 5 working days. So big relief here. The rationale is pretty simple here that now the markets are very matured and the information dissemination system by the listed company and entire media, whether it is soft, printed or verbal or visual or audio media, this flows very quickly and the investors are able to absorb the information very quickly. Therefore, such long notice periods are not required, 7 days. It has been reduced to 3 working days. So compliance officer, in view of this revised timelines, we can update our SOPs for any annual general meeting or any other general meeting or for any matter which affects the record date. Yeah, so there are certain, as I spoke in the previous slide, there are certain omitted regulatory provisions. Earlier, there was a requirement that every quarter, the compliance officer and a representative from share transfer agent need to submit a certificate to the stock exchanges saying that the share transfer process is with either in-house or wherever applicable it is with the RTA. So that kind of certificate was required to be submitted every quarter. Now, most of the company have share transfer facility moved to RTA. Very few still continue in-house. So this provision was brought in a lot of years before, in my view, and therefore no longer required to be quarterly certificate is no longer required now. Loss of physical certificate, any certificate was required to be given. This is also done away with. There was since physical shares has been holding of physical shares is now permitted, but it cannot be traded. So any annual certification regarding that, any timeline regarding processing request related to physical shares, this has also been done away with. So these regulations and now more of redundant certificates have been done away with. Yeah,
So
that
now we
brings
can
on. Yeah. To the Q&A session. I
Mhm.
think,
Yes.
yeah, I think the users are there waiting for their questions. Let's shoot.
Right, right. So, first of all, before taking the audience questions, I have two questions with respect to the advertisement. Can a company publish advertisement in their own format? Because they have to just publish the QR code and the details. So there is no specified format issued by SEBI, so they can use their own format.
Yes, absolutely, Mayank. They can use their own format. Uh, the publication should be clear enough as to these financial results to which company for which period, and under I think initially we can educate our stakeholders that why this QR code. So as per the latest amendment, this has been given an option to the listed company that we can publish it this way. Those small words to clarify stakeholders who have not followed the law as closely as compliance officers have been doing it. So those kind of clarity can be given and it can be published in the newspapers
Okay.
in our own language.
And can a company use the existing advertisement format along with QR code and web details?
I didn't understand this one.
So,
Existing format
of publishing the financial results in newspaper.
this is a practice I have also observed. So some companies, what they have done is, in the last prevalent format for publishing the results in the newspaper, they have published that for particular format and also given the QR code that the detailed results can be referred here. So this practice I have seen people are doing this practice. So yes, while publication of QR code or publication of the financial results in newspaper as per the prescribed format, it is an option. People have been doing both.
Thank you, sir. So there's one question from Ms. Rishu. Notice in newspaper at the time of dispatch of postal ballot or e-voting details at the time of AGM, EGM to be given?
To be?
To be given.
No, not to be given. This has
Okay.
been done away with.
Okay. Question from Mukta. Do we have to file old CG report and CG report under integrated filing both?
The compliance CG report, as per the circular that has come on 31st March 2024, there has been a revised template that has been prescribed. Am I right, Mayank, in this one? And that particular template has to be followed for integrated filing.
Yes, sir. Yes, sir. Yes, sir.
Right.
Pursuant to circular dated 31st December.
31st December 2024.
Yes.
This is the stock exchanges have also circulated to the
yes,
compliance officer of all listed companies. This circular says that gives a separate template for the corporate governance report. And this template has certain additional disclosure which is required to be made as compared to the previous format. So I would request all compliance officer to look at the latest template.
So one more from Ms. Rishu. Central Pollution Control Board or Electricity Department will be covered as sectoral regulator? I think yes
No,
for
I don't.
Discom. I think yes for Discom companies, sir. Because Discom companies or whomsoever are the distributor of electricity, then I think their prime regulator is the electricity department or that CPCB. Your views, please, sir.
2 points. As you rightly pointed out, Mayank, see, the electricity regulator, I don't know its exact name. If that regulator imposes any fine or penalty on the distribution company, then it is a sectoral regulator which has prescribed a penalty. And in that case, threshold would be 1 lakh. But the electricity distribution company, suppose it detects electricity theft and it imposes a fine and penalty on the user. In that case, that electricity distribution company and the person, in this case a listed company, they are not regulator to each other. The distribution company is not a regulator for the listed company. So it will fall under the category of any other authority. So in that case, the threshold will be 10 lakhs.
Sir, question from Mr. Raj. Whether shareholder meeting agenda for appointment of secretarial auditor will be an ordinary resolution or special resolution?
Special business, ordinary resolution.
Okay. From Mr. Anand, if the transaction of the listed subsidiary has to be rectified and value of transaction is 50 lakhs, the materiality level is 25 lakhs for the subsidiary, whether this transaction can be rectified? Can I repeat this, sir?
Yeah, see, yeah, please repeat.
If the transaction of the listed subsidiary has to be rectified and value of the transaction is 50 lakhs, the materiality level is 25 lakhs for the subsidiary, whether this transaction can be rectified?
See, moment we are saying that is a listed subsidiary. So let's forget about the subsidiary concept here. It is a it is a listed company. Okay. So for listed company, whatever the related party transaction mechanism has been provided for a listed company, we will have to look at that. So if such materiality threshold, not only under the materiality policy, but also as per Companies Act and also as per LODR, we'll have to see, and accordingly we will have to go ahead with the required approval of audit committee, board, and shareholders. In this particular case, even if I presume, I'll just extend this question. Suppose it is a subsidiary company which is not listed, and the materiality threshold is, and whatever with the transaction 50 lakhs, it is exceeding the materiality threshold, then the ratification thing is gone. Ratification is not available here.
So Mr. Sumit wants to ask, our company is exempt from regulation 17 to 27. In light of this, does the requirement under regulation 24 to appoint a secretarial auditor for 5 years still applies to us?
So if it is a blanket exemption from 17 to 27 all in a row, and that has been exempted, then it is yes, exempted here also, because 17 to 27 will include 24 also, will include the newly inducted 26A also. I hope I am understanding right.
So there are certain exemptions given in regulation 15, if I'm not wrong, that okay, for certain companies, regulation 17 to 27 are exempted. So I think if regulation 17 to 27 are exempted for that particular company, then I think they need not to abide by that regulation, sir.
Absolutely right. I agree with you. In regulation 2, this has been regulation 15 sub regulation 2 of SEBI LODR. This has been prescribed, and the proviso gives that. No, the main regulation only gives that exemption.
Ms. Jyoti wants to ask, Labor Law Authority is the regulator for listed company?
That's an interesting question. Can we come back on that one? We'll have to do some bit of research.
Okay, another one.
Vivek, on this point, I also have one point here. So if I'm a manufacturing entity, and all the EHS regulators and the Factories Act authorities, are they secretarial regulators for me?
Which one? Can you repeat, Jyant?
Factories Act and EHS regulators, are they sectorial regulators for me? Maybe if I'm a listed entity having manufacturing setup.
See, in my limited understanding and view, I would say that labor authorities are not sectoral regulators, because those those authorities have a say, or they have a oversight of all companies. They are not limited to one set of companies, uh, or any particular industry sector or any particular business sector. They have all encompassing uh, oversight. So in my view, they are not sectoral regulators, because LODR is very clear as to what is a sector, that it is a sectoral regulator, though it has not been defined. So labor authorities, they do not govern any specific sector. So they would be considered, in my view, as a general authority.
Thanks, Vivek.
Sir, next is in
Welcome.
integrated filing, regulation
Yeah.
pursuant to regulation 10(1)(a, we don't have to
Mhm.
intimate stock exchange separately as on governance and financial reporting regulation.
Can you please repeat that, Mayank?
Yes, sir. In integrated filing,
Yes.
pursuant to regulation 10(1)(a,
Uh-huh.
we don't have to intimate stock exchange separately as on governance and financial regulation. So I
Yes,
think
correct. You don't have to
yeah.
separately. You don't have to separately intimate.
Okay. So another one from Ms. Sheetal, for
Yeah.
litigation fines and penalty,
Mhm.
if not material, still we have to disclose quarterly in CG integrated filings.
Material what?
So for litigation, fines
Uh-huh.
and penalties which are not
Uh-huh.
material, which are
Uh-huh.
not material,
Mhm.
still companies have to disclose in CG quarterly filings.
See, I think an aggregate of all those non-material litigations and non-material penalties needs to be consolidated and filed uh, in a quarterly manner, is my limited view and understanding. And I think if we have enough enough space, or a kind of enough information requirement that is required under corporate governance report, then we can do it in corporate governance report. Otherwise, as a separate filing, we should do this to the stock exchanges in the best governance practices.
There is one question from Hetal.
Yeah.
Acquisition disclosures applies to purchase of share
Yeah.
securities for companies
Uh-huh.
primarily engaged in investment activities. So should investment companies have to disclose that acquisitions on each and every transaction they do?
So I think the first clause of para A of Schedule 3 will have that clarity. We may not be required to file it for investment companies, uh, but yes, I think on a quarterly basis we can consolidate it and file it for investment companies also.
Mr. Lakshmikant wants to ask, what if board meeting ends after
Mhm.
6:30?
Mhm.
What if board meeting ends after 6:30 p.m., that is around
Mhm.
4 hours after market close? So what is the ideal time to disclose the outcome of the board meeting?
See, the law allows you 3 hours time. So any meeting which ends after the market hours, usual market hours ends at 3:30 p.m. in India, NSE and BSE. So 6:30, if the meeting is ending at 6:30, that is also after market hours, and you have 3 hours time to uh, make the filing to the stock exchanges. And after 3 hours, you again have the entire night, after which the next trading session starts. So that particular reason, you have full 3 hours.
There's one question from Ms. Deepa.
Mhm.
What extra approval will be given by audit committee for promoter remuneration, which is approved by NRC? Please clarify what has to be presented to audit committee.
Okay, see, the perspective of NRC and the perspective of audit committee is slightly different. Therefore, it has to pass through the filter of both the committees of the board. So NRC's typical view on the remuneration would be to align it with the responsibilities of the promoter KMP or promoter director or promoter SMP. So with the align it with the market. So align with the abilities of that particular individual, align it with the market, and also align with the perspective of peers of that particular position. Okay, so these are the perspective of NRC. Whereas the perspective of audit committee is to look it from the perspective of numbers of the company vis-a-vis the remuneration. So that way, suppose the stature of that particular person is so high that it demands a remuneration of, for example, 1 CR per annum, but the company is in a SME sector and its financial does not warrant to afford a person who has such high remuneration, high or whatever, maybe low, whatever people may understand it. So the perspective of audit committee is totally different from that of the nomination and remuneration committee, and accordingly we'll have to put it across to the respective committee as to what specifically points we have to bring out. As I already mentioned, to NRC we can bring out to mark to market, mark to the capabilities and the education of the experience of the particular person, peer comparison, and for the audit committee it should be compared with the EBITDA, PAT, PBT of the numbers, top lines, total revenue, total turnover of the company. That way it can be mapped.
Thank you, sir. One question from Mr. Rashmi Ranjan Nayak.
Yeah.
If CFO is not in the board and CS is reporting to CFO, how it can be taken forward?
So in that case, such compliance officer should immediately get in touch with the CFO, his manager, and also with the Chief Human Resource Officer, CHRO, and also loop in some executive director on the board, and then carry forward the communication or carry forward the requirement of the regulation to these set of relevant people. And depending upon the situation of each and every specific company, there are other key decision makers. So in collaboration with all these people, the compliance officer, since it is a matter wherein the compliance officer himself will have to educate the relevant stakeholders about his own position, about the regulation update in regulation that has happened. So he'll have to play a well balancing role in elevating his position and in terms of educating the stakeholders about the legal requirements. So a balance between these two extreme ends has to be struck, and accordingly it has to be taken forward with bit of a tact and bit of a sensitivity.
So the last question from
Yeah.
Jyoti. What if the company is listed outside India? Also, do we need to take into consideration working time outside India for disclosure of with respect to those financial results?
So usual trading hours, if you see the definition of trading hours in the PIT regulations or in the SEBI LODR, it will be for the BSE, NSE or the recognized stock exchanges in India. So that is the requirement of regulations in India. If it is listed overseas also, then stricter of the two you'll have to comply with. You'll have to see what regulator in the other country is prescribing. So you'll have to strike a balance or comply both of them. And comply both of them means obviously complying the stricter one of them, and the other one will also be taken care.
So one more from Ankita. So in case the independent directors meeting is scheduled to be held in February 2025, should the listed entity hold another independent director meeting before 31st March 2025 in order to comply with the amendment to have two independent director meeting in a financial year?
So in my understanding, this this amendment prescribes the listed company to make this a best endeavor practice. So for FY25, 2 meetings may not be necessary. For FY26 onwards, we can adopt that practice.
Thank you, sir. And we are taking the last one, sir. And
Yes, please.
questions keeps. So if a company is listed on one stock exchange, then company needs to file integrated filing to that stock exchange.
See, the platform for integrated filing is a separate platform. And the unified filing, is that the right name, Mayank? The unified filing has to be done with the designated stock exchanges. So out of the two stock exchange, BSE and NSE, you will have to choose, every company has already chosen as one stock exchange as the designated stock exchange. And with that stock exchange, you will have to do the filing, single window filing. And for integrated filing, there is a separate platform which has been prescribed.
Thank you, sir. And I think we have tried our best to take each and every question from our audiences. Thank you, sir. Over to you, Jyant, sir.
Thank you so much, Vivek. It was pretty interesting, and I'm just looking at the time. It's exactly 6, so this has gone
Yes.
for 2 hours. That is
Yes.
not how we had planned it for, and I can still see the questions are still pouring in. Every audience is still glued. So you made it very, very interesting. Thank
Thank
you so
you.
much. And I think very patiently you try and address every queries. While I could see there were a lot of repetitive ones also, which were somewhere addressed earlier in the discussion. But thank
Yeah.
you so much. Uh, and you know what? And what specifically, just I just want to look at when I was listening to you. A couple of my thoughts, which I definitely want to put an emphasis on. Yeah, I think these amendments are very, very positive ones because I think the regulator is trying to understand how the market is moving, what are the pain points, and trying to also reduce the cost of compliance, removing the unnecessary ones also wherever required. As I see in the newspaper, obligation to put this in the newspaper instead of having a full report, you can put a QR code. I think these and to do away with setting a physical for annual reports. These are very, very welcome moves because these are unnecessary cost of doing compliances. And and one very positive thing which I would say is that now the compliance officer is going to
Mhm.
report to the board. I think I
Correct.
see this as a game changer because whenever I have sat in specifically I would say I would have sat with the company secretaries and I've sat with the company risk officers, chief risk officers globally. One common thing that I've seen in India, the compliance officer is seen as a tick box, requirement, not aligned so much with the board. But today, it's a welcome start that you are, making it align with the board. Somewhere you will have a place in the board, and it's the regulator saying that I'm not going to take compliance easy. Uh,
Absolutely right.
I think I think it's as a community, the company secretaries have to take this as a big achievement. As if
Indeed.
if I would say, if I would say that the CA community and the CS community, the CA was always seen as the board guys. CS had a very I don't want to use the word, but I think somewhere very clerical work also. Uh, uh, but this is a very welcome move. I think we should grab it and make the impact feel in the board meetings because board has to very sincerely see what the compliance officers bring on the table. And I think the board has also now accepted that they can't be lenient on the compliance. So
Absolutely.
yeah, I'm saying it's a good move, and I hope. And I was also looking at it. I'll try and see if we can publish one FAQ, and we may need your help again because there were a lot of questions and very pertinent one. Akshay, this is something which I'm putting in for your consideration. If you
I'll be
can,
glad to participate, Jyant.
we'll need that support. Thank you.
Yes.
And I think it brings us to the end. If you have any last word to say, otherwise, I want to thank everyone for such patient listening, and I hope we keep coming back to you with more such engaging discussions.
I would say that you have very nicely, very aptly summarized the position of our profession in the industry. See, my thought process has always been that whichever legal entity, promoter or director, they value governance. For them, the regulator will not they will not wait for the regulator's prescription that you have to strengthen their position, you have to make it better or whatever. They have already been a step ahead in the governance practices. And for the laggards, see, it is all upon the thought process. See, they will continue to be finding some or other way out to be a laggard, and it also depends upon the professional. So while each professional has to carve out its own niche, these kind of subtle pushes and subtle tailwinds that the regulators, that our Institute of Company Secretaries provides from time to time, I think gives a great boost to the not only a personal position of any compliance officer, for a personal position of an individual. This is a quantum shift in the overall corporate governance framework, overall business scenario, overall industry. So wherever there are people, wherever there are legal entities, you will find good, bad, gray everywhere. So the moment we strengthen the position of compliance officer, these grays and blacks will keep falling into the places of whites. So it's that we are not only making a change in the regulation, we are making a change in the industry. Entire ecosystem will get pushed towards a better governance zone.
Right.
So, and I thank you, Jyant and Mayank and the entire Lawrbit team. You have been great
Thank you,
in
sir.
bringing all the insights on the table, dissecting every provision that has come in. You have been tremendous and instrumental in preparing a fully amended SEBI LODR, which is not yet available with the regulator. So I would request your Lawrbit form to publish that for the good of all the stakeholders, and it would be a great asset for all of us to read through. So we are
For sure, sir.
I will welcome it. I'll be the first one to grab it up and read it.
For
No,
sure,
That
sir.
I
We
can
will
both
publish
ask
that.
you.
No, I think good you reminded. That's something we will surely do that.
Yes.
One, we will try and have FAQs published, and second, we will share with all the participants who registered for this webinar today the copy of one. I think many people have asked for the copy of this deck also, and the
Okay.
regulation. Both of them.
Super.
So thank you so much, Vivek. And again, wonderful having you here. We look forward to more of such sessions. And thanks, everyone. Have a good day.
Thank you,
We are
everyone.
stretched.
Thank you.
Thank you once again, everyone.